Alrighty, good afternoon, everybody. Thanks for joining us. Welcome back to another Money Talk Tuesday. This week is Investing in the Age of COVID-19, presented by the U.S. Securities and Exchange Commission. This is a quick little agenda. We're going to go over about the Office of Economic Empowerment, disclosures, housekeepings, and then we will introduce our speakers for this afternoon. But do stick around to the end. We have an exit poll that provides us some feedback about this webinar and also provides an opportunity for you, our guests, to suggest other topics that we can cover for future Money Talks. About the Office of Economic Empowerment, the Office of Economic Empowerment is a department within the Office of the Treasurer and Receiver General of Massachusetts, tasked with supporting, advocating, and facilitating policies that empower all Massachusetts residents. Our programs serve women, families, high school students, veterans, and seniors, and our priorities include closing the wage gap, increasing access to financial education, improving college affordability, and investing in STEM careers and education. Full disclosure, this is a Zoom webinar and will be recorded. The recording will be uploaded onto a public website for future use. This webinar is also being streamed live on Facebook. Any information shared through the question functions will be anonymous, but please note that the chat record is subject to public record laws and as such is not anonymous. So for those of you using the app, you'll see that it's in that small black bar at the bottom. You can click Q&A or you can click chat, but again, the Q&A can be anonymous. For housekeeping, like we said, this is a webinar, not a meeting. You will not be able to see other participants. You can use that chat feature to communicate to the host and the panelists, and you can use the Q&A at any time throughout the webinar. And one more time, please complete the exit poll before you leave. And in September 8th, we'll be doing a Money Talk Tuesday on all you need to know about divorce, presented by the Financial Planning Association of Massachusetts, VESTA, the Massachusetts Collaborative Law Council, and the Massachusetts Council on Family Mediation. If you want to register for that, you can go to the bit.ly in the RSVP. If you're on your phone or you have the opportunity to do it, take a picture, take a screenshot. This is also available on our Facebook and our mass.gov upcoming events. Any questions, you can always email us at moneytalk@tre.state.ma.us. And we hope to see you there. Without further ado, I'm going to hand this off to our next presenter, Ms. Adriana Schick. And thank you all for coming and enjoy. Adriana, you're on mute. 1 second. Were you able to unmute yourself?
There we go. Sorry about that. Thanks, Shaitia, and thank you to the Office of Economic Empowerment for inviting us today. We are excited to be here. I thought I'd kick things off today with a brief poll of our viewers to get a better understanding of how many of you are maybe currently investing or may have made changes to your investments in the past 6 months. And by investing, what I mean is having your money invested in securities such as stocks, bonds, mutual funds, real estate, or other similar types of products, through personal accounts, brokerage accounts, even, retirement plans with your employer. So Shaitia, would you go ahead and post those? Great, thank you. And while we wait for folks to respond to those questions, I'll give some more background about the speakers today and the SEC. So first off, we have Paul Levinson, who has served as the director of the Boston Regional Office since October 2013. Paul leads a staff of over 160 lawyers, accountants, business experts, and other professionals who are responsible for enforcing the federal securities laws in and around New England. Jennifer Brady is a senior counsel in the Boston Regional Office and has been with the Commission since 2015. Within the office, Jennifer is part of the Market Intelligence Group, which analyzes tips, handles investor inquiries and complaints, and educates investors to help them make more informed financial decisions. My name is Adriana Schick, and similar to Jennifer, I am also a senior counsel in the Market Intelligence Group of the Boston Regional Office. Before I continue, I want to give a quick disclaimer, which is that the SEC, as a matter of policy, disclaims responsibility for any private publication or statement by any of its employees. The views we express here today are our own and do not necessarily reflect those of the SEC, its commissioners, or any other members of the SEC staff. And I also want to note quickly that that the SEC, it's an independent agency of the U.S. Federal government that regulates the federal laws that govern the selling and trading of securities such as stocks, bonds, mutual funds, and other products. The SEC's mission is to protect investors, maintain fair, orderly, and efficient markets, and to facilitate capital formation. And I just want to make a quick note that we won't be providing legal advice or investment advice today. And by that I mean, we're not going to tell you which investments to buy. The SEC does not certify stocks, bonds, mutual funds, or other securities. Just because those products are for sale does not mean that they are good investments or suitable for any particular type of investor. We are also not going to tell you what kind of financial advice investors should be getting or how much they should be paying for it. What the SEC does is that it ensures that the people and the companies selling you those securities, selling you the stocks, the bonds, and those mutual funds are telling you the truth and are treating investors fairly and honestly. So to that extent, we'll be focused more on general principles of sound investing and avoiding fraud in today's talk. So now that we've introduced ourselves in the SEC, let's turn to the results of the poll. And it looks like there's a good number of viewers who are currently investing, and it's about split with our viewers, that some have changed those investments in the past 6 months, and others have not. So with that as a foundation, let's go ahead and talk about how the current COVID-19 pandemic has impacted investors and the markets. And for that, I'll turn it over to Paul.
Well, thanks, Adriana. I'm delighted to be here today. So thank you to the Office of Economic Empowerment, and thanks to everybody who's tuned in. I hope we'll be providing useful information. To start with the obvious, there's been a huge impact across the economy and across the markets from the current pandemic. We've seen in the economy itself massive unemployment at levels we haven't seen since the Great Depression. We've seen terrific dislocations for a lot of people whose jobs or their small businesses have been upended. The human consequences have been tremendous, and the economic consequences are tightly connected to those human consequences. One of the things that's happening is for folks who have been laid off or out of work, they're having to go into savings. They're having to go into money that they had set aside and aimed for retirement, and instead they need it to keep body and soul together or pay the rent. So that's a direct impact. Inside the financial markets, what we're seeing is a lot of volatility. There was an initial sharp downturn in most of, especially the equity markets, the stocks and other shares of companies. In March, there have been a series of sudden rebounds. At this point, we're looking at very high valuations. The Standard & Poor's index had 3 record days in a row. And you know, that's challenging to make sense of. In part, it's worth remembering that the stock market is connected to the economy, but it's not the economy. It reflects, especially in the larger indices, the largest companies in the economy, and is weighted by valuation. So if certain sectors of the economy are doing well in a pandemic, and obviously parts of the tech sector have become more important than they already were in American life as people are in remote settings, that may move up an index in ways that doesn't necessarily reflect how the whole country or how the whole economy is doing. At the same time, we've seen legislation that has changed some of the ground rules around investing, in particular I think it was motivated primarily to allow people who have to access their investments in order to draw down money now that they would have liked to have saved for retirement. The CARES Act has reduced withdrawal penalties and eliminated a number of withdrawal penalties for IRAs, 401ks, and other retirement savings vehicles. From the perspective of a financial regulator in the financial system, one of the things that is at least worth paying attention to is all of the financial professionals, good and bad, are aware of these changes. And we have seen an increase in people trying to persuade investors to change products, change strategies, buy new products, and part of the sales pitch being based around the idea that if you're not going to have the same withdrawal penalties you ordinarily would, you might as well go ahead and make a change. And one of the things we'll be talking about is that investors need to be alert to the full range of costs associated with any given investment decision. So to the extent that people may face pressure or sales pitches based around the idea that the waiver of withdrawal fees makes moves cheaper than they otherwise would be, you still have to be careful about the overall costs. So I guess that's, Adriana, that's just, I suppose, setting the backdrop for what we're seeing specifically in this area.
Thanks, Paul. Talking about investment services and fees, I'd be curious to know how many of our viewers are working with a financial professional or consulted with a financial professional, over the past year about managing their money. And by financial professional, I guess I should explain that I mean, a broker, an investment advisor, or really another person or firm that helps assist you with your investment decisions. So Shaitia, could we post that poll? Great, thank you. And while we wait for our responses, we can check really quickly if there have been any questions. I know it's early on in the presentation, so there may not be, I don't see any. So we'll give folks a little more time to respond. And while they're doing that, Paul, I'm wondering if you would talk a little bit about how the current climate has impacted financial firms and professionals.
Okay. Obviously, one of the most direct impacts is lots and lots of folks in the financial industry are working remotely. And so you don't have people physically in the office. Early on, we spent a lot of time and energy touching base with large and small financial firms in the Boston region. I mean, the Boston region covers all of New England. And so if you want to look in big picture terms, that's about $12 trillion under management, and everything from the huge mutual fund complexes to individual investment advisors who may serve individual family clients of folks who are saving for retirement. And the things we were looking at is to the extent that there were a significant number of people trying to get out of stocks and bonds initially and get into treasuries or other lower risk securities. Was the market itself able to handle it? Just the sheer volume of trading. Certain firms were hit harder than others. On the whole, the good news is the plumbing of the financial system held up really, I'd say, fine, meaning you didn't have broken trades and and trades that couldn't be completed. People were able to move their money where they wanted to, and large movements took place without big disruptions. We've spent a lot of time since then really focusing on where are the areas we need to be looking out for risks that may be different, and some just changes to what we're generally concerned about. So when we're talking about financial professionals, brokers and advisors, to some degree you'll see this with financial planners or insurance professionals as well. Particularly at a time of disruption, are people getting the fees right? If you've withdrawn large amounts of your savings and you're paying a fee based on how much your investment advisor is overseeing, you may well be entitled to a reduction in fee, or in some instances, people may need to have the fees double checked and have some money coming back to them. So making sure that the firms are doing this, that they're computing fees accurately, that they're following their agreements with their clients and customers has been a high priority. And that's an area that has long been challenging. Most investors would think reasonably, I give my money to a financial professional, especially if it's an investment advisor. They're a fiduciary. They owe an absolute duty of good faith and fair dealing. I should be able to count on them to make sure they're computing my fees right and that they're not overcharging me. And mostly that happens, but there's a fair amount of mistakes or sloppiness in that people need to be alert to, and people shouldn't be shy about asking their investment professionals to double check. A couple of other things in this environment that have had our attention, where investment professionals are no longer working together in an office, but may be working remotely. Supervision, making sure that what people are selling, what they're telling their clients, how they're dealing with their clients and customers fits with the policies and procedures of the firms they work with. It's harder to keep track of what people are doing and make sure they're following those rules. So that's an area where we've been looking closely at whether firms are effectively supervising the folks who work for them. And another thing that I think really across the board, folks listening today should be thinking about is, because so much is happening in remote environments, hackers, thieves, cheats are going to be trying to get at sensitive personal information. And this can happen in a variety of ways, including hacking into people's own mail accounts. It's not as simple as one day you find out you've been hacked into. It may simply be that a hacker has the ability to monitor large numbers of email accounts and notice when you're emailing or having contact with a broker or other financial professional. We have seen things like people doing withdrawals, sending instructions to wire money to their banks, and hackers at the last minute changing just the last email so that the money gets wired into the hacker's account instead of into the customer's account. So it's an area where multi-factor authentication and other basic email and cyber safety precautions are important, but also where picking up a phone and confirming, double checking is a good idea. It's just the risk is there, has been there even before COVID, but with everyone in an online posture, it has increased, and people really need to be alert to that.
Thanks, Paul. I just want to circle back to the poll question we had asked previously about working or consulting with a financial professional, it looks like, based off of the results, it's almost split with slightly more people working or having consulted with a financial professional in the past year. And so for those working with a financial professional, or even those thinking about working with a financial professional, I want to briefly highlight the SEC's website known as investor.gov. And we'll show you that a little later on in the presentation. But this website, investor.gov, is a free online resource for investors. And there is a very simple and free search tool right on the homepage of investor.gov that lets you check out the background of your current financial professional, or any future, if you're thinking about working with somebody, a broker or an investment advisor. You can go to the homepage of investor.gov and type in their name, and the tool itself is called Check Out Your Investment Professional. And like I said, we'll show you that in a little bit. So moving on, Paul, one thing you mentioned during your, while you were talking about how COVID-19 has had an impact on investors is you mentioned sort of an increase in fraud that may be impacting investors. It might be helpful to talk about specific types of fraud or scams that we've seen during the current pandemic. For that, let's turn it over to Jen.
Thanks, Adriana. Yeah, so fraudsters often use the national or global events to lure investors into scams, and the coronavirus is no exception. We're seeing some scams that we have seen before, but again, we're seeing them with this event as well. So I'll go over a few of those. First up I want to talk about fraudulent promotions, particularly related to microcap or penny stocks. And for those that don't know, in general terms, microcap stocks are low-priced stocks issued by the smallest companies. And what we're seeing is fraudsters using false claims about a company's products, services, abilities to treat or cure coronavirus in order to lure investors to invest in the company. What sometimes happens is these fraudsters will use these false claims in order to pump up the price of the company or the stock price of the company. And then after the stock price is at an inflated price, they will dump their shares on the market. And we sometimes call this scheme a pump and dump, because they're pumping up the price and then dumping their shares at those inflated prices. Although false statements can be about any company, I mentioned to be particularly skeptical about those with microcap and penny stocks, and that's because of the limited information available about those types of companies. There's often limited information available about finances, management, services, products, and that allows fraudsters to more easily provide these false claims and thus profit at the expense of unsuspecting investors. One method fraudsters use to target investors for this type of scheme is through a boiler room operation. And this is where fraudsters will cold call or maybe use email promotions in order to really solicit investors to invest in these particular companies. So if you're considering investing in a company, especially in a microcap or penny stock, be skeptical of claims that products or services can prevent, detect, or treat COVID-19, or that they could help solve issues related to the current pandemic. And be skeptical of companies that appear to cycle through different types of unrelated business activity very quickly. That is a red flag. You mentioned the coronavirus, Adriana, and speaking of the coronavirus to date, we have suspended training. The SEC has suspended training in more than 24 companies that had questionable claims related to COVID prevention, detection, or cures. So Paul, I don't know if you'd be able to provide us with some information about one of those matters, or just more generally what we have been seeing lately.
Well, I can do a little bit of both. So a trading suspension really, it's not a final determination that something is definitely a fraud. It's a determination that the information in the market is insufficient to allow investors to make a reasonable decision about whether something is worth buying or selling, or what's a fair price for it. So what we've seen a lot in this area are claims often from companies that were previously in completely unrelated lines of business, that all of a sudden a company that was previously involved in, say, environmental recycling announces that it's in the clothing business and has expertise and contracts for making personal protective equipment or medical grade masks or other items that may be scarce during the pandemic. We've seen folks claiming that they are part of fast-tracked FDA programs for development of vaccines or development of possible treatment modalities. And again, the claim is we're on a fast track, we're part of an FDA program, and very often these claims are not supported. There's no information to back up that they are true at all. And as you pointed out, Jen, when you're dealing with the microcap companies, for larger companies, the SEC requires that companies publish on a regular basis their financial statements. Those have to have been audited by independent auditors. They're laid out according to strict rules on how financial and operations statements for companies have to be prepared. For smaller companies, the SEC does not prohibit those companies from being bought and sold. They're generally not sold on exchanges. The exchanges, the larger exchanges, certainly will not allow the buying and selling of stocks in these off-exchange or over-the-counter stocks, because there just isn't enough verifiable financial information about them. But in this day and age of no commission trading and online trading, it can seem like sort of the same thing. You know, you're buying a stock, you can buy a share very often through an online broker of something that is or is not an exchange traded company or a NASDAQ traded company. And sometimes there are warning flags. Literally, some of these come with a little skull and crossbone next to them. But if you get a call from somebody who's working for a call center who's been hired to try and push one of these stocks, they may well offer a pitch that goes something like that. It may start with, they're going to have your caller ID may show them calling from right in your area code, and they may tell you they're with a local firm. That's very often spoofed. We've seen boiler rooms from the Philippines. We've seen boiler rooms from Canada and offshore, anywhere they can find people to do this kind of work. Usually they're going to hire people who don't have foreign accents, and they're going to call using a spoofed area code and say they're from nearby, and they're going to give a name of a firm, and they're going to invite you to go look at the website for the firm. And sure enough, they'll have a website set up. It may not be there next week or next month, but it's probably going to say that their firm has been in existence for 15 or 20 years. And they're probably going to be telling you that they have a great track record for predicting winners. And they're probably going to point you to particular stocks. They're going to say, go look it up. 3 months ago, we predicted that a particular stock was going to go from nothing to absolutely huge, and go look it up. There it is. And all they're doing is they're looking back and finding stocks that have had sudden big increases. And they're telling you they recommended it 3 months ago, when their so-called firm may not have even existed 3 months ago. So all of this stuff is built to create a picture of an established financial advisory firm, an established track record, to make it all sound respectable. And they're going to tell a story about why this new stock that they're pitching is a great investment. If they don't have a good story, they're not in the business of defrauding people. That's just what people who do frauds do. So you're going to hear a really good story about how this particular company happened to have patented a product, or happened to have developed a product, or happened to have hired just the right scientist at the right time, or happened to have contracts with a manufacturer. They're going to have a whole explanation. The thing that you're almost always going to find, though, is that call's never going to end with their saying, go ahead and do some research around the internet, check with a legitimate financial advisor and see what you think. It's always going to end up with, if not the first person who calls you, then they'll say, you know what, let me get my manager on the phone to you. And they put on someone they call a closer. But the goal is always to get you to say yes. Very often it'll literally end with somebody saying, okay, do you have an E-Trade account? Do you have an online brokerage? Okay, let's open it up right now. Okay, do you see the first screen? Okay, so go ahead and type in these identifying letters for the ticker symbol for whatever the stock is they're trying to get you to buy. Go ahead and type that in. I'm sure your broker will have it available. And they will be walking you through to close the deal, because the whole reason somebody is paying somebody in a call center to talk to you about this stock is because they're trying to sell it, and sell it in a hurry. What, Jen explained how a pump and dump works. The piece that probably obvious to everyone here, but it's not just that they pump up the stock by getting people excited about it and then they sell their shares. The next thing that happens is you own those shares, and they stop the promotional campaign. They stop spending money on people calling from call centers. They stop spending money on publicity or ads or hype to try and push up the stock price, because they're done. They've got their shares sold. And immediately the share prices, as people try and sell and realize there's nobody other than folks getting phone calls from a call center who really wants to buy this stuff, the stock drops. And it may drop from, they may have pushed it up to 50 cents a share, or depending on the stock, $5 a share. And very quickly you're back to trading at half a cent a share or 2 cents a share. The pitch is always going to be, look at this thing going up, look at the stock prices, it's going up. You want to get in on it before it reaches the top. By the time it's already gone up with one of these campaigns, they're looking to for you to be the person holding the bag when they stop the campaign and see the share prices drop.
Thanks, Paul. I wondered, let's stay on scams and specific types of fraud, but let's switch gears from penny stocks and pump and dumps to other types of scams. One scam in particular we've made aware of involves phony certificates of deposits. Jen, would you be able to shed some light on that scam and sort of help investors, understand how to tell the real from the fake?
Sure, yeah, so great. As you said, we've been seeing these scams related to phony certificates of deposits promising these higher rates than you can find at other financial institutions. And the SEC actually recently issued an investor bulletin on this very topic. So we'll drop that investor bulletin as well as some others touching upon the scams that we're talking about in the chat so that you have reference to that. But regarding these phony CDs, what we're seeing happen is that a lot of them are being promoted through spoofed websites. And so when I say spoofed websites, what I mean are websites that mimic real websites or look like legitimate financial institution websites. And the way these get spoofed are, oftentimes you'll see the URL address will be very similar, or you may see a logo that was copied from a legitimate website put onto this spoofed website. You might also see results when you go to search on your favorite internet search engine. You might find that these spoofed websites show in the top search results, and that's because some of these spoofed websites will also pay to advertise so that they are coming or are showing at the top of those search results. So again, you might see a website that has a name or a very similar name to the name of a bank or a well-known financial institution, but it's possible that you're not really dealing with that bank, or you might not be dealing with a bank at all. So some of the red flags that you can use to spot this particular type of scam, first, if they're offering interest rates that are higher than you can find at any other financial institution, that is a red flag. If they're promoting only certificates of deposit and no other financial products, such as brokerage or banking products. And when I say that, I mean, banking accounts, loans, commercial banking services. That's something else to look for. A third thing to look for is oftentimes they'll require high minimum deposits. And here I mean around 200,000 or more. So if you think you're buying a certificate of deposit from a reputable institution, but you're being asked to wire the funds outside of the US or to an institution with a different name, that is a big red flag. Again, if this happens, be concerned that the bank you think you're dealing with is not really the bank that you're dealing with, or again, might not be a bank at all. It could be a situation where that financial institution, their information, their logo, their name had been spoofed into what appears to be a legitimate website, but is not. One of the things you can do if you are looking at certificates of deposit and you're not sure, conduct internet searches and see if you are finding information other than that first link you found. I mentioned that you might get results that will show the spoofed website. But see, are there review websites? Are there other web pages that support that this is a legitimate institution, that this website is real? And if the website claims that the certificate of deposit is FDIC insured or offered by a credit union, you can verify with the FDIC or the National Credit Union Administration either online or via phone. And the investor bulletin that's being linked in the chat includes contact information for both. So it includes the option to search for the bank online or to call the FDIC or the National Credit Union Administration to confirm. When you do that, however, make sure that the name you are asking about is the exact name, because again, oftentimes spoofers will use a name that's very similar. They might just drop the S at the end of a name, for example. So make sure you're looking for the specific name. And I see it doesn't look like we have any other questions, so I do want to touch upon one additional type of fraud that we're seeing. This is not the only, these three are not the only types that we're seeing, but these are ones where we're seeing happen more often during these times. And that's affinity fraud. Unfortunately, with any demographic where there is a group of like-minded people, sometimes they are targeted. We call this affinity fraud. And this could be a social group, a religious organization, a civic organization. We've even seen frauds targeted directly at members of the military. At its core, affinity fraud exploits the trust and friendship that exists in groups of people that share something in common. And fraudsters may be part of the group, or they may simply pretend to be part of the group. Oftentimes what they do is they enlist a leader of that group to help spread the word about the scheme. And those leaders might not realize the investment is fraud or is a scam. They might actually be unwitting victims themselves. For example, a couple of years ago, we sued a pyramid scheme promoter called Telex Free that was essentially running a Ponzi scheme. Telex Free started in Brazil and then targeted Brazilian and Brazilian Americans living in the US. In some cases, those perpetuating the fraud were also victims and were being used by the real fraudsters to expand their reach deep into various ethnic communities. And again, there are other types of scams. We just wanted to highlight a few of the common ones. But in addition to the investor bulletin linked in the chat, we'll also provide some other investor bulletins that cover the information we're talking about today. But if you only remember one website, that would be the one Adriana mentioned earlier, investor.gov. And it's easy to remember, plus it will provide all of the information that we're linking to today and more. So Paul, I'll turn it back over to you, if that's okay.
Okay, there's, we've talked a lot about one of the areas of risk that certainly I worry about when I think about retail investors in our market, which is the risk of catastrophic loss, the risk that you're getting ripped off, the risk that you're being sold an investment that maybe somebody has high hopes it's going to take off, but it's way too risky. It's just too much of a long shot to be betting any more than a small part of your future on it. And it's not uncommon when people are excited about a new idea and they're trying to raise money there for them to say, oh no, this can't miss. We've got by far the best product. We've got by far the best chance. We've got, we've just had a breakthrough in the lab and we're gonna cure COVID-19. And so you can't miss. You should put all your money in this. So the combination of predators who are just looking and who are very skillful at stealing money from people, and folks who are trying to raise money for ventures that maybe they have high hopes for, but that you really have to be realistic. And that can be very hard if it's, a former, somebody from your unit in the military or somebody from your church, somebody you know well, and they say, all these other folks are doing it and you should get in on this too. This is how we're all going to take care of ourselves in the future. It can be very hard to say, I don't think I want to put in any more than I can afford to lose. And that's really got to be your test on this. The reality is large returns in our financial system come with large risk. If you step back and think about it, when I mentioned that there's $12 trillion of assets under management in New England, that means there are thousands upon thousands of financial professionals who are involved in trying to invest that money. There's a lot of really smart people with a lot of money looking for good places to invest. And I know Adriana says this all the time, but if somebody's coming to you and saying, I want you to take $50,000 out of your IRA and invest in this product, if it's really as good as they say, why is it that they haven't been able to sell it to somebody who has millions to invest on behalf of often large numbers of investors who will professionally analyze the opportunity and decide, is it worth the risk? So you really need to be thinking about that if they're asking for your money, why do they need your money? Or if they tell you they're doing a favor and they're just giving you a chance to get in on something that everybody else is putting more money into than you are, you want to see the money and you want to really ask the question, why me? Why am I being pushed for this? Something separate, I did see in the initial poll, a significant number of folks are working with financial professionals separate from the risk of catastrophic loss. I think people need to think about what I would just call being an educated consumer and thinking about how much money you're spending for financial advice. Financial advice costs money. There's no question about it. The people in the financial industry are in it for profit. There's absolutely nothing wrong with that. But you need to be thinking carefully about what is the advice I'm getting and how much am I paying for it. And right now, it's somewhat coincidental that it came online during the COVID crisis, but since July, the SEC has required all financial professionals, brokers or investment advisors, to give you it's actually a total of 2-page summary of what is your relationship and how much. It includes questions like, how much are you paying? And are you paying every time your broker suggests you move to a new product and you pay commissions? Are there withdrawal fees? Are there penalties for early withdrawal if they put you in an annuity and then tell you another annuity is better? It may well be that it's going to cost you more money to get out of the first investment and into the second one than you can possibly make up in the time you're going to hold that second investment. And the thing about financial service products is, again, I'm just going to state the obvious. It's all about money. If you're deciding what kind of car you want to buy, and you do research and there are two cars and they're both well, the reviews are positive, they're both well known, they both are well regarded, but you just plain like one better than the other, it may well be worth it to you to pay the money to buy the one you like better. When it comes to money, it's just money. There's no reason to pay more for a product unless it will either make you safer or make you more money. And it has to make at least enough more money to be worth the cost. So when you're thinking about how much financial advice you need and what you're paying for it, think hard about that. One of the things that's really hard for folks to take into account is if you're working with an investment advisor and you hear a figure like, well, we'll take 1% of just the assets we manage. 1% sounds like a small number, and if it were for just 1 year, maybe it would be. You do the math, you figure out what that 1 year is. But the whole ball game in investing is compounding, that you hope that you make money and then you have more money to invest, and then if that makes money at the same rate, you have more money to invest, and over time that grows. What's important to remember is compounding works in both directions. So if you're paying 1% in order to make 4%, 5%, 6% in a market, that's a quarter or 20% of all of what you're making, you're paying. And next year, that's money that hasn't been added to your investment and isn't going to keep growing. That's money that's in the pocket of the advisor you've paid. And over time, over the 20 or 30 years people may be saving for retirement, that can compound to add up to tens or hundreds of thousands of dollars that you'd like to have to retire on, and instead in the pocket of whoever you paid for advice. So you should be asking, if I'm just interested in relatively low risk products and I want to just hold them for a long time, why would I want to pay 1% every year for advice to keep doing the same thing? Now, maybe you've got a financial planner who's offering a full array of services and it's really worth it to you. But you should be asking, would I be better off paying a one-time commission or going directly? In many instances, these things may be available without commission, and making sure my money is actually in the investment and not in the pocket of an advisor or professional. So you need to be thinking in terms of, how do I look out for myself in this market? And now it should be easier than it's been in the past because your advisor or broker has to give you this one-page summary and they have to lay out for you. I mean, if at any point you're dealing with somebody who isn't telling you how they get paid and every bit of how they get paid. So if they say, oh, I only make money if you trade, but they're also offering a linked bank account or a linked interest earning account, they are obligated to tell you, oh, and by the way, I get a share of the interest that the bank pays. The amount you're getting is less than the total that's getting paid out. You need to know these things, and they're required to tell you, but you should also be asking and adding it all up, because while the first fear, and this is something we see often, is catastrophic loss, the second fear is just that you will end up with significantly less available to retire on or to pay for kids' educations with because of the fees you pay up front. That's a little bit of a side point from some of the things we've raised. You know, Adriana, one of the things that comes to mind here is there are legitimate companies doing work to address COVID in different ways. At the same time that there are fraudsters out there trying to cash in and get people excited, how can investors go about protecting themselves and getting information to sort through whether they're looking at a real investment or something that may be a fraud?
Yeah, it's a good question, and the reality is it can be really tricky to identify, you know, truth from fact from fiction. Truth from lies. You know, fraudsters are experts at manipulation. And that goes back to, you know, them creating these fake websites, calling you from phony phone numbers, and creating fake firms that sound legitimate. But fraudsters, they also use psychology and employ a variety of persuasion tactics that are aimed at, you know, manipulating investors emotionally so that they base their decision on something other than the merits of the product or the investment itself. And in today's climate, you know, those types of tactics can be simply offering words of comfort or even friendship, which can be really, you know, compelling in this day and age now with so many people socially distanced and not in regular contact with their familiar social circles. But it stands that, you know, these tactics that feed on your emotions, you know, these are red flags of fraud, and learning to identify some of the common tactics will go a long way to helping investors identify, you know, potentially fraudulent investment schemes. So a few of the more common tactics that we know of are, you know, first off, the guarantees and promises of high returns. Combining guarantees with the prospect of wealth or of a specific amount of money that you will earn can be really compelling, especially now when folks are feeling less financially secure. But, you know, as Paul alluded to, and as I do say often, you know, the old saying is true that if it sounds too good to be true, it probably is. That really guarantees and high returns don't often go together when you're talking about retail investing. Another tactic is high pressure sales tactics that, you know, the time is running out sales tactics. You know, get in while you can, don't miss the once in a lifetime opportunity, that really try to create a sense of urgency and that, you know, pressure investors to make a decision, a quick decision in the moment, instead of taking the time to actually research the investment and understand what that investment could do for you, or the risks involved. So, you know, short of it is, don't be pressured to make that decision in the moment. No legitimate investment opportunity requires a quick decision. Take your time and do your homework. Research the investment, research the people selling you that investment. And again, investor.gov is a great resource that will show you in a bit on where you can look to either check the background of the individual selling you the opportunity, or, you know, even just understanding more about the type of investment product it is. Another persuasion tactic that's often used is, you know, fraudsters will often offer you something for free to try to entice you to invest or to make you feel obligated to return a favor. This can come in many forms like, you know, fee waivers or a free lunch or dinner while they talk about the investment opportunity. This type of persuasion tactic is referred to as reciprocity, which is, you know, sort of the I'll scratch your back if you scratch mine. And really, investors should not feel obligated or pressured to invest just because they did something for you. You know, again, this is your money. Take the time to understand how it's going to be used and how much of it is going to be used for you. And bear in mind too that those free lunch seminars or free dinner seminars are now opportunities via video conferencing. And so the reality is just because you know, you're not in person meeting with this individual, you know, you may be over the screen, you know, they still can be trying to employ these persuasion tactics to manipulate you. So bear that in mind. Another tactic is, you know, the use of fancy titles or specialized expertise. You know, and this goes back to what we talked about, so I'll be brief, but, you know, short of it, you know, they may add titles, they may add names, create websites that show legitimate financial services, or as Paul alluded to, they can also explain past successes they've had with picking securities to try to convince you to invest with them. But all of these things can be very easily made up. So it's a good idea to do your own research and not just trust what this person is telling you. You know, successful con artists know how to sound professional, and they know how to foster a relationship of trust or confidence in their potential victims. So it really goes a long way to doing your own research and checking out, you know, what this individual is telling you about the investment opportunity. And a couple of other points that I just want to mention, these sort of step away a little bit from persuasion tactics and are more just sort of, you know, blatant red flags that you should bear in mind when considering an investment opportunity. And that is, if there's a lack of documentation, be skeptical. Investors should always be able to learn more about an investment opportunity or a company that they're interested in by looking at public filings or even private documents offered by you know, the investment that sort of talk about what the investment is, what the company is, financial statements, you know, that show you the company has been operating and is in good health. So if there's a lack of documentation, that's often an indication that the investment opportunity is either not registered or the person selling it to you is not telling you the whole story. So be skeptical.
Adriana, I'm going to interrupt you here just because I know our time is tight, and
Sure.
ask if Jen can get us to investor.gov and at least show us what that looks like and tell us a little bit about how that can help really with this kind of research. Jen, you may be muted.
Yes, I was. Thank
Yeah,
you.
okay.
So this is investor.gov. In the beginning of our presentation, Adriana had mentioned a very easy tool that you can use to search for your investment professional, and that is right here, right on the homepage. All you need, as you can see, is just the name of your professional. And if you want to search for a firm, you would just click right here, change it to firm, and you would enter the firm's name. So you really do not need a lot of information in order to use this tool. And it's a great tool because it will show you it will show you if the person is licensed and registered, which is important because what we see is that a lot of unlicensed individuals selling securities are targeting retail investors or are part of these, you know, fraudulent activities that we've been describing today. It also will show you the background, potential disciplinary actions, or the employment history of the individual you're working with. There is other information on investor.gov. We mentioned investor bulletins, we've mentioned financial tools and information about fees. So if you're just getting started, this is a great place to go because you can get information about investment professionals. Paul discussed understanding fees, and here's some information right here. It's one of our spotlights. But again, we oftentimes will create investor bulletins that will touch upon related topics of the times. For example, we've recently created a couple on the coronavirus, and you can find this information on our website. Again, Introduction to Investing, Investor Alerts and Bulletins, but there is a whole lot more information on this website. We just wanted to touch upon those resources that we've been talking about today. But I encourage any of you, whether you're new to investing or you have been investing for a while, to take a look here, both for investment basics, tips to avoid fraud, financial calculators, and, you know, again, if you have any questions, you can certainly reach out to us. And Adriana, I believe if you'll be willing to share our contact information for our viewers.
I will, yep. And so importantly, you know, if with everything we've talked about today and beyond, if you think you've been scammed, feel free to reach out to our office. You can call us directly at 617-573-8800 or email us at boston@sec.gov. And that information will hopefully be in the chat. And another thing is you can also file a complaint online with the SEC. If you go to www.sec.gov/TCR, and that stands for the Tips, Complaints, and Referrals Portal by the SEC. And I know we are short on time, so we may not get to questions. So to the extent there are questions you have that weren't addressed or that you would like to run by one of us, feel free to email those questions to the boston@sec.gov or call us at the phone number 617-573-8800. And with that, I just want to give a huge thank you before we sign off to Shaitia for hosting us today, and to the Office of Economic Empowerment for creating the space and this opportunity for us to share this information. And thank you obviously to all the viewers who tuned in as well.
Thank you all. Thank you all for giving us your time today and your expertise. It's been awesome. For those of you guys who are still with us, if you don't mind just doing the quick exit poll before you go, that helps us get some feedback based on today's webinar. We also have a survey that'll be going out via email. If you don't get the chance to do the exit poll right away, there's another opportunity. As always, if you have any questions, please email us at moneytalk@tre.state.ma.us. And if that is all, I hope everybody has a wonderful day. And thank you again for joining us. Take care.